Today on InvestTalk, we look at the September effect and how it should impact your asset allocation. Then we dig into the major market sell-off today. We also answer questions about Bank of America, Broadcom, ASML, and more. And at the end, I look at the dividend irrelevance theory.
This is InvestTalk. Independent thinking, shared success.
There are main focus point concerns the September effect and should you really sell your stocks? How much credence should you really put in to this seasonal volatility that we're experiencing now? And the September effect refers to the stock market's historical underperformance during the month. And yes, September has been market's worst performing month in the last 10 years, 20 years, and since 1950. And since 1925, it's actually had an average negative return of 0.78%. Negative 0.78%. Now, that's skewed, however, because there's been a couple of really bad Septembers since 1925. The first one is 1931. Right during the Great Depression, the S&P 500 lost 29.6% in September of 1931. Okay? And then you add on top of that the 9% drop in 2008 due to the Lehman Brothers collapse. Remember that? So those two numbers over, yes, a lot of years, still skews it pretty poorly. In fact, if you actually take instead of the mean, the average, okay, a return of, once again, negative 0.78%, instead if you look at the median, which is the middle, okay, what is the middle performance, meaning half the years it performed better, half the years it performed worse, which kind of gets rid of the extreme outliers, both on the upside and the downside. If you look at that, it's actually zero. That's the median return is just flat. And that's over the last 98 years. Now, over the past century, stocks have risen in September slightly more often than they've fallen, 51% to 49% when they've fallen. Okay? So it's kind of a 50-50 shot. And it's not that September is necessarily a terrible month. Generally, it's not. It's just a very middling month. And if you give it a little context, such as a presidential election, you actually will see that Septembers during presidential election years are generally positive. 2/3, about 15 of the 24 election years since 1925, the September month has been positive for equities. And the median return in election years is actually 0.3%. And so you cannot look at this in a vacuum, say it's September, it's not going to be good. Yes, it hasn't been so far, but doesn't mean we can't have a rally. Look at August. August is also seasonally weak. We had a sell-off in early August due to the yen carry trade unwind. And by the end of the month, things were positive. We rallied through the back half of August. Could that happen again? Absolutely. There's no reason it can't. Now, there are various explanations for why this is the case. One explanation is, hey, traders come back from summer vacation. They're rebalancing their portfolios in September, which increases selling volume and volatility, putting pressure on stocks. I don't really buy that because generally when you're rebalancing, you're selling some and you're buying others. So kind of net, it's not really an issue. Now, the one theory I think does hold a little bit of water is actually the fact that September is usually a time where bond sales tend to pick up. Once again, there's not a lot of issuance in August because of summer vacations, things like that. Those traders come back, they issue more bonds, and guess what? That's risk. If they're taking duration risk or taking credit risk, that's risk on a portfolio, and oftentimes that money is coming from equities to kind of balance out that risk. So I do put a little credence in that, but what's actually most underappreciated is the fact that it's tax season. Everyone thinks tax season of April timeframe. Well, that's personal. Well, September is business taxes. And so if you are trying to pay taxes and you need money, you're a small business, a lot of times that money will come from equities. And so that kind of pulls some liquidity out of the economy due to those tax payments, and then suddenly there's a potential sell-off and less liquidity in markets. So don't be shocked to see September continuing to be a choppy month, but months come and they go. And so soon we'll get through the month of September, and then it's going to be more about the election, inflation, Federal Reserve policy, whether banks are continuing to lend or not. All that's going to be far more important, and it all adds up to the odds of a major crash in September are very, very low. It's only happened twice. Doesn't mean it's going to happen this year. In fact, there's not really a lot of catalyst for that. The credit markets are holding together, and there's really not a lot of reason for you to get up in arms about it. So that is September effects, and don't get too caught up. Let's take a look at the market today. It was a decidedly red day overall, mainly for large cap growth, down 2.3%. Broadcom was one of those big losers there, down about 10%. Livewire was down about 11%. Let's see, what else? There were some big movers. Tesla was down, I believe, 8%. Where are we? Yeah, 8.5% on the day. Nvidia was down 4%. Google down 3% and change. So Amazon was down over 3%. So a lot of big names getting dragged down into the mud. Netflix down about 2.3%. So a lot of big negative movers on a jobs report that was clearly worse than expected. What's interesting to me is the market is not pricing in a 50 basis point cut yet from the Fed coming up in not next week, but the week after. Okay, there's still a 70% chance there will be only a 25 basis point cut. And clearly, the market doesn't like that, right? They want 50. They're not signaling 50, despite a payroll number that came in at 142,000, and that is up from the prior at 89,000. I believe that was revised down. And so, if you're looking at some of these numbers, average hourly earnings that did tick up year over year and month over month. So that was not good. You had higher earnings, so higher inflation, but you had weaker total non-farm payrolls compared to the consensus. So you also had unemployment rates tick down a bit. So kind of a mixed bag on whether or not the Fed has enough ammo to go 50 basis points, but clearly the market wants that. And the dollar was up a little bit, so that was interesting as well. Just a choppy period as we kind of been expecting. Okay, so don't be shocked by this. It's not anything to really worry about, but know that these days are going to come, and this is another day where value drastically outperformed the growth side of the market. You had once again large cap growth down 2.3%, whereas large cap value down a little over 1%. So nice 1% kind of delta between those large cap growth and large cap value. So very interesting day in markets to close the week, and we head into the weekend.
Hey guys, Randy from Tampa. Thanks for all you do. Had a quick question. Wanted to get your opinion on ticker symbol MOAT, Moat. Been looking at adding a position to it, and not sure if it's in a good opportunity to buy or if I should continue to wait for a bigger pullback. Please let me know your thoughts.
Well, it's all equity, so it's seasonally going to be weak, just like it was today. It was down a little less than 1%, but the broader market was down a lot worse than that. So certainly weathered the storm. And for everyone else out there, this is the VanEck Morningstar Wide Moat ETF. And when someone says a wide moat, that's a Morningstar speak. Morningstar, one of the biggest independent analysis firms that's out there. We use Morningstar mainly for ETF mutual fund analysis, but also individual stock analysis as well. It's always interesting to see their takes. There's no conflicts of interest with Morningstar because they're not dealing with they're not a investment bank trying to issue shares or bonds or anything like that. So that's why it's nice to have Morningstar being so independent. Now, in their speak, a moat is simply, think of a castle, and the moat around that castle is how much barrier is there for a competitor to come in and steal the business and hurt the business of the company. And so it's another word for competitive advantage, shall you say. And there are various sources of what we call economic moats, and they can be narrow in Morningstar speak or wide moat. And for this ETF, it's really about owning those wide moat companies. So the top 10 holdings are Altria, RTX, which is, I believe that's Raytheon, International Flavor and Fragrances. They make flavors and fragrances as you would imagine. Campbell's Soup, Kenvue, which I think is the spinoff from Kellogg's, I believe, if I'm remembering correctly. TransUnion, Gilead Sciences, Fortinet, MarketAxess, and then Equifax. So what you can see here is not a lot of the same overlaps from the large tech companies that dominate the major indices. So I like that. Healthcare is number one here, 21% of the portfolio. Then then industrials at 19.5%, technology at about 18%, and then consumer defense about 15%. Zero energy, which is interesting. Zero utilities, so not a lot of exposure there. But I like the concept of it. We love businesses that have an economic moat to some degree, that have that are high quality, have high profitability. Not sitting here focused on big dividends. It pays a dividend about 1.4%, but not something that is the main driver here. And I really like that. So I think it's a fine ETF to own. On a pullback, say to the high 80s, right now it's at 93 and change. I think that's an area that you'd want to pick up MOAT. If you're looking for just broad-based exposure to quality names, that's very different than the broad indices.
I would like to know your opinion on the Broadcom after today's news and drop in stock. What is your opinion on the pretty much longer future, not the near future? I mean, here is just a reaction.
Yeah, you're looking at AVGO, that is Broadcom. And yeah, it did have a rough day today. It looks like it's down over 10% and really dragged down the semiconductor space as a whole. And I believe that was on earnings that did disappoint just a bit. And they're still good, right? Positive 47% year over year on revenues and then 18% on earnings. But as usual, it's not just about what happened in the past. It's about how they guide towards the future, and the markets, didn't love that, and so that's why it's down. We like Broadcom, but the technicals now are decidedly poor, and this looks headed for a protracted pullback here. Let me give you a support level. It's going to be at 96. It's at 137 now. That's the area that we would be interested in picking it up at 96. Good company, good balance sheet. We like Broadcom as it's near the, it's in our top 5 of semiconductor names that we like in the marketplace. But I would be waiting for a pullback because I think near term there's definitely some headwinds to the semiconductor space, as a lot of money flowed in there during the AI craze, and a lot of that money is coming out right now.
Yeah. Thank you. Really appreciate you guys. Awesome show. Really appreciate it.
No problem, George. Thanks for the call.
Hi, this is Brett from New Jersey. Thank you for all that you guys do. I know you've been getting a lot of questions about bank stocks, and Bank of America is one that's been on my watch list for a while. Thinking about picking it up. Do you guys think it's going to go any lower? And if so, what do you think is a good price to pick it up at? Thanks. Appreciate it, guys. Take care.
All right, looking at Bank of America, and this is a name that has been weak over the past 7-8 weeks or so. It peaked back in early July, mid-July, and it peaked at a high of, about $44. Now we're at 38 and change, and it just made a lower high. So it is now in a clear downtrend. Where is the next major support level? I'm going to say all the way down to $32 per share. So I think that's probably where it is headed as we head into a choppier period. And, Bank of America, it's not the worst run bank out there, but certainly not the best run bank either. So I would actually be very patient on this name down to $32. Thanks for the call. Now, I hope you've been telling your friends that our InvestTalk audio podcast is available in video form over on our YouTube channel. So make sure you head over there and like and subscribe to the channel. And we get questions submitted via the comments section over on YouTube. And here's one that came in earlier. Jim Leahy says, do you like NXRT for a medium to long-term investment? This is let's take a look here. NXRT is the symbol, and this is a small cap REIT that acquires, owns, and operates multifamily properties, mainly in the southeastern U.S. and Texas. So I think an apartment REIT, and I like the location, right? A lot of people are moving to the southeast and Texas, and their business has been really booming. Up until late, however, where revenues are falling 8% last quarter, even though funds per operation still is going up. It's actually set to be negative. FFO is expected to be negative for the next 4 quarters, and it's actually supposed to be down 15% this year. So I don't like that. And generally, rents are peaking out. There was a lot of building of multifamily apartments across the country, especially in the Smile states, which NexPoint operates in. But it's really been overbuilding in many respects. So I don't love that. And this does look like it's rolling over right now. So I wouldn't be too excited. They have a lot of debt in their balance sheet. Their free cash flow is good, but not amazing considering the size of the company. And that funds for operation or free cash flow is turned south. It was at $98 million in the first quarter of last year. Now it's at $82 million. And headed lower. So I just don't love the recent move in the charts, and I don't love the the fundamentals after this recent move. So I think there are better REITs for you to chase out there. Okay, thanks for the call. Now let's talk a little bit about the election. We are in election season, and many times the election can be tricky for investors. And there are historical patterns depending on who is in the White House and as well as Congress. And, number one, the thing you have to remember is stocks tend to go up, whether it's a Democrat or Republican in the White House. Okay. Now, who controls Congress, along with who's in the White House, also shifts those patterns. Okay. All still positive, just in different ways. Okay. Now, Ned Davis Research examined data from 1901 through January 31st of this year. And they looked at annualized rate of return of the Dow Jones Industrial Average under a Democratic president and then under a Republican administration. Under a Democratic president, 8.2% annualized from the date of inauguration. And under a Republican administration, only 3.2%. Now, that's nominal. When you take into account inflation, you have higher inflation under a Democratic administration, but still net 3.7% under a Democrat administration in real terms. Under a Republican, 1.4% annually in net of inflation. Okay. Now, the makeup of Congress does have an impact here. Under a Democratic presidency, the stock market has performed better when they've had the Republicans in power in Congress. Means checking their power, meaning not a lot is being done. Status quo, and things tend to be fairly steady. Okay. Now, the Dow posted a real return after accounting for inflation of 8.1% under that scenario. Think about it. It's 8.1%. That's kind of the best of both worlds. When you have a Democrat in the White House and you have Republicans in control of Congress, checking that power, meaning it's not Republican or Democrats across the board. Now, under a Republican presidency, stocks have performed better when Congress is also controlled by Republicans. And they've posted a real return of 7.1%. So when Republicans are in control of Congress, that tends to be pretty good, no matter who's in the White House. Now, historical data can provide some insight into market behavior during these presidential elections, but results can be skewed by macro events. So just because this is what tends to happen doesn't mean it's actually going to continue to repeat. So understand that. There are multiple factors at play here. But it is good to know kind of what generally gives a good or poor backdrop to the overall market, depending on who's in power in the White House and in Congress. Now, from a sector perspective, it's also very, very interesting. Under a Democratic president, cyclical stocks tend to outperform. Under Republican presidencies, usually defensive stocks tend to outperform. And that just goes to show you inflation. Remember I talked about Democratic presidencies tend to have more inflation? Well, inflation is typically good for cyclical stocks. Disinflation or deflation tends to be good for defensive stocks. Okay? Now, communication services, energy, and financials have had the highest median relative return 6 months after the election when Democrats have won. So 6 months after. Communication services, energy, and financials. When it comes to Republican administration, healthcare and consumer staples, along with financials and communication services, have done the best. Now, over an entire presidential term from 1972, information technology and industrials had the best track record of outperformance during Democratic presidencies over the full 4 years. Okay. Under Republican administrations, healthcare has the best record, outperforming the Dow 75% of the time, while industrials, that's pretty interesting, right? You would think that Republican administrations would be very good for your blue-collar industrial businesses. Well, no, they've had the worst performance, outperforming only 25% of the time. Now, what does it look like going forward based on the current Trump and Harris proposals? Well, Democrats are likely to be tougher on bank regulations, so bank stocks would do better under a Trump victory. Same with LNG stocks because of LNG export rules. They should do better if Trump wins. And the industrial sector, maybe a mixed bag in this case. It will speed up. A Trump administration would speed up deglobalization, good for domestic, small cap industrial companies. However, what do tariffs mean for particular names that maybe produce outside the country? I think that will be interesting. So I think smaller cap industrials would do better than those larger cap industrials under a Trump administration. Now, healthcare stocks have historically performed poorly when the president's party also controlled Congress, mainly because of a risk of overhauling things and throwing uncertainty into that particular sector. Now, both candidates are trying to control drug prices, and neither seem very friendly to big pharma, especially in the Trump administration. If RFK becomes part of that administration, obviously he rails big against the farm industry, and so I think that would be really bad for that sector as a whole. Now, once again, these are generalities. It doesn't mean it's going to absolutely happen, but it's good to know that backdrop. Elections don't happen in a vacuum, and there are a lot of variables that are important, from interest rates to inflation to what banks are doing. Are they lending more or not? All of these factors are important in understanding where the markets are headed, not just who controls the White House. It has an effect, but it's not the only effect, okay? And so that's kind of where we're at with the election season. You're going to get a lot more information as time goes on, as we head towards Election Day in November. Now let's keep things moving and tackle another InvestTalk listener question. You know the number. It's 888-99-CHART.
I was calling about Franco-Nevada Corporation. Its ticker symbol is FNV as in Victor. I was calling to see because I'm looking at, the current economic situation we're in now. So I'm trying to find a nice precious metal or gold, play or stock to get into. And I was looking at this one, and I just want you to just give me your thoughts on this one. I was thinking about buying it. Just let me know. I'll listen to it on the forecast.
All right, looking at Franco-Nevada, and this is not a gold miner, but it's a gold streaming company, okay? And we actually really like these type of businesses. We've owned Franco-Nevada for some time. They are having some near-term headwinds with an issue with one of their mines down in Central America. But overall, it's a very well-run company. Now, what they do is they invest in mines that others are operating. So they're not typically operating the mines. They're putting equity stake in different mines and helping finance them, lower the risk that things will go poorly for the actual mining company, and it allows them to gain a stream of income from each of these mines as they eventually hit full production. And so they have a ton of these throughout the world, and it is one of the most profitable, consistently good balance sheet that's out there. And so we like Franco-Nevada, despite the near-term issues with a couple of their mines in Central America. We still like it long-term. So a good play, probably not the play that's going to have the most upside if gold goes up, but will be the most consistent longer term. Okay. Now on Fridays, we generally take time to fit in a quick rundown of some key benchmarks for this week. The 2-year Treasury yield down pretty big from 3.925% to 3.677%, obviously on the back of a weaker the weaker jobs number and pricing in a more aggressive Fed easing cycle. And so pretty big drop from that nearly 4% level the close of last week. And we were at 5%, okay, on the 2-year just less than a year ago. So we've already had 100 and nearly 50 basis point drop in the 2-year Treasury yield, reflecting that expectation of the Fed easing cycle. And once again, this, when the Fed eases, the market's pricing that in, and that's what the market has priced in as of late. Now, the 10-year, that dropped as well from 3.92 to 3.72, and you can see that's a steepening of the yield curve. And the 2-year has fallen more than the 10-year did this week, and now we have a positive yield curve. Think about that. For a while, we had a negative yield curve. Now we have a positive yield curve, okay? And that's going to be good for banks to continue to lend more. Gold priced at $24.95 an ounce, down from $25.02 an ounce, down a little bit this week, but still kind of in that general uptrend. Slight zigzag for this week. Silver, that was also down a little bit from $28.86 to $27.92, but in general, remaining in that nice positive uptrend that precious metals remain in, especially in the back of a weaker dollar as of late. Oil, the big mover on the week, $73.54 at the close last week, down to $67.82. And this is going to be a nice impetus for the Biden administration to refill the strategic oil reserve. I think this is an area that they'll certainly think about doing that. And you're going to see the oil companies pull back at this level. 67 and change, just not a level where these oil companies are going to aggressively pursue new supply. And so OPEC, they pushed off their increase in production another couple of months. But overall, this is reflecting what the market thinks is a weaker economy overall. Gas prices down to $3.29 per gallon nationally, down 6 cents over the last week, and down from $4.25 114 weeks ago, about 2 years ago. So in California, our average still is $4.66 a gallon, down 3 cents from last week and 7 cents from a couple weeks ago. And in comparison, Oklahoma down to $2.86 per gallon. Huge difference. Okay. So that's where we're at. But before we get to a break, let's play another caller question now.
Hello, would like to get your opinion on ASML. Thank you.
All right, looking at ASML, this is in the semiconductor space, and it's a semiconductor equipment company, the largest out there, a very important name. However, this has rolled over in a big way. The semiconductors in general have just had a big rollover. It's a name that's on our watch list, but this is to come into some good support. And let me do this. There we go. It is coming into some support here around $737 per share. I will say that. But to me, the major support down around $650. $650 is the level that I would pick up ASML. Let me look at the fundamentals here. The earnings are supposed to be $20.69. That's down 6% from last year, and it's still a $750 stock. So you're talking about middling growth here, and trading at 30 plus, nearly 40 times multiple. That's just too high. This needs to come down at least to 650, and then I'll start thinking about it. Then I have to see, okay, are the trends in earnings improving for next year? Are they getting worse? Right now, they're getting worse. And so until that turns around and the stock hits reasonable support, I would continue to lay off ASML. Now, here's another question that came in via the InvestTalk YouTube channel. Thomas Ike says, can you discuss dividend irrelevance theory and whether a passive investor might actually benefit from dividend stocks, from less rebalancing? Could less experienced investors benefit from the strategy without having to take time-taking capital gains? I love this question because it's so important to understand. And what dividend irrelevance theory suggests is that a company's dividend payments don't add any value to a company's stock price. And I agree with this. Dividends are overrated. Now, they have value in my mind because it does, in many instances, it brings a level of prudence to management to where they might have cash flow coming in and they don't want to be the ones to cut the dividend. And so what they do is they're a little more selective on the investments that they make, the buyouts that they make of maybe other smaller companies, because they don't want to use up all their cash that is being used to pay out a dividend. And so it brings a level of discipline to management. And that is important. Now, is it the most important thing? No, it's not. Because generally, if it's a good manager, whether it's paying a dividend or not, they should be smart at knowing where to allocate capital and not need the handcuffs of the dividend to bring prudence to their decision-making process, right? Because, and so dividends are only best for that. That's it. They seem cool. They seem like they have value, right? It's nice to get cash in your account, but it's not the end-all be-all. In fact, we've talked many times about how companies that have low to middling dividends and no dividend at all actually perform the best as opposed to those high dividend payers. Because remember, it's all about the quality of the business. I can't say that enough. Because we get calls all the time still. Companies, REITs, ETFs paying huge dividends. And that's all they're focused on. And that should not be what you focus on at all. You should be focused on, what is this business? What is the balance sheet? What does leadership look like? What's the quality of their services? All of that is far more important. So I like that you should everyone should implement the dividend irrelevance theory. Now let's talk a little bit about stakeholder capital. And ESG was all the rage in the past, and now there's a lot of fighting against it. There's in Texas, for example, there's some lawsuits going around, and it's really pushing back against the idea of ESG. But what you have to understand is that it's not fighting back against the idea of stakeholder capital. In fact, it's exactly the opposite. Even if you look at J.D. Vance, the Trump's VP candidate, he's calling for his rhetoric talking about calling for companies to support local communities, workers, national security interests. Okay, and in fact, this is just a variant on stakeholderism, stakeholder capital, as opposed to shareholder capital. Shareholder capital was the 90s and early 2000s. It's all about what is good for the shareholder. Now, whether you're on the right or the left, it's really about how are you taking care of the stakeholders in the business, whether that is the workers. Okay, that's kind of the next best, most important stakeholder, the local communities, and the country as a whole. How are these companies really fulfilling of those duties. Okay. 40% of Americans trust government. 40, that's it. 53% trust businesses. And so now it's more about how are the businesses taking care of society at large and those that are involved in the business. And so to me, in many ways, stakeholder capital is simply evolving. ESG is a bit too controversial. And, that's why there's woke capitalism, things like that. But stakeholder capitalism continues to evolve and flourish. And this will continue to be an important aspect of how companies operate going forward. Now, I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. Independent thinking, shared success. This is InvestTalk. Good night.